Jeff MacDonald. Stocks have actually been hitting new highs this summer, but it's on very low volume and very low volatility, and that's scaring a lot of people. A lot of people say they're worried about the market being overvalued. Are munis the best place to seek safety if you think stocks are a little bit overvalued?
Yeah, we certainly think for our clients that the municipal market is a great place to allocate assets. I think in a broader portfolio context, it certainly provides that income and that stability that a lot of investors are looking for, especially with concerns about the equity market. I think when we look globally at the bond market, we've got roughly $13 trillion of bonds in the global marketplace trading at negative yields. So within the U.S. municipal market, you have positive yields, albeit they're at historical lows. But again, it's a very safe market, a very high quality market. And for U.S. investors, especially ones that are in higher tax brackets, we certainly think it makes a great deal of sense to have that be an allocation within a portfolio context.
But munis have really run up over the past year. They've appreciated nicely. Still cheap on a tax equivalent basis toward treasuries?
Yeah, when we look at our higher tax paying investors, we certainly look at the muni market quality adjusted, that it makes sense on an after tax basis for our investors. So if you look at the muni market where you can capture yields in 5 years of around 1%, you've got to get well north of that in the taxable bond market. And to do that, you either have to take on more interest rate risk, which we really don't favor in this market, or more credit risk. And we know credit risk is another part of the bond market that's become overvalued, like stocks, and we really think that on an after-tax basis, having high-quality munis and taking some of that interest rate risk off the table makes a lot of sense.
There is risk in the muni market, though. You're not worried about Chicago or Illinois or Puerto Rico spreading. There's no contamination factor.
We don't see that. There are certainly challenges credit-wise in the municipal market. I think the broader municipal market is very healthy. We've got an economy that's growing. We've got a job market that's healthy. All these things contribute to the creditworthiness of the municipal market. There are isolated instances like Puerto Rico, like Chicago, and Detroit before that, where municipalities got into trouble and really had fundamental challenges that are going to take time to certainly work themselves out. But we do believe that these are isolated. It's a lot of work that we do to try to find these situations, but broadly speaking, the municipal market is a very diverse market and one that we can find value in away from some of those headline credits.
All right, and what about supply? Are you seeing a lot of new paper hit the market? Is it mostly refinancings?
We're seeing a lot of refinancings, and supply over the last few years has been lower than it's been historically. On the flip side of that, we've got a lot of money coming into the market. So we're over 40 weeks of positive fund flows into the municipal market. So that's created a very positive technical backdrop, which has caused the muni market to perform as well as it has, and for spreads in the muni market to compress like other parts of the bond market that we've seen. We did discuss earlier about infrastructure. If the infrastructure, we start to get some traction there, most likely that will be financed through the municipal market. So we may get some relief and some higher supply going forward as we transition to a new administration in Washington, and the willingness to take on some of these infrastructure projects picks up.
And if there is a project, you like revenue bonds, so you don't mind if there's a new sewer system put into place or a new bridge or new airport, because that's the area of munis that you like.
Yeah, I think so, because what we have an outlook for the U.S. economy that it's growing. It's not growing gangbusters, but it's certainly a muddle along trajectory. As long as we have that economic activity, those revenue bonds, the creditworthiness of them will improve as the usage of those services improves. When we look at all the bad headlines in the municipal market, a lot of them are coming at the general obligation level. And what's causing a lot of these are other fundamental problems, but the pension liability issue for those issuers is starting to come home to roost, and we expect that to be a challenge for some of those issuers in the future. There's plenty of great GO issuers. We invest there pretty actively, but the pension liability is one we focus on at the GO level.
All right, well, thanks a lot, Jeff.
All right, great. Thanks for having me in.
And thank you for watching The Street.